We're starting our program, and our presenter is Delia Fernandez. Eugene, um, do you want to kind of just, this is week 6, so this is our last session. Do you want to just, for the video audience, as to how to use our website?
Absolutely. Thanks, Pete. Let me share my screen. Okay. If you go to iyme.org, it will forward you to our website. It's yourmoneyandestate.org. From there, you could go to workshops and click on It's Your Money. We are in the final week, week 6, financial planning part 2. This is where our video will be posted within, let's just say, a week. And our program documents are found here, the outline for Delia, as well as her Ask First form. Further down the website, you'll find the related articles.
You know, if you could scroll down a little bit more as far as the articles are concerned, I want to pick out a couple of them. One is there's an article on there that says 7 ways your brain makes you a terrible investor. We don't talk about behavioral finance much, but it's an excellent article about how our brain actually sometimes works against us as far as making us a better investor. And Daniel Conaham is kind of a leader in this area, but Richard Thaler is absolutely, he's a Nobel laureate. It's a fascinating article. And since we haven't talked about it much, but if you can go to our website and read that article, I think it's an eye opener. So if you have adult kids that you have problems with as far as cutting them off financially, there's a great article on that. This is when to cut off your adult kids financially. Some of these the scams are now using artificial intelligence.
Right.
And so for us who are experienced in this area, we get fooled. So, you know, scamming is just huge right now. You got to protect yourself. But anyway, just want to make sure you know about those articles there, and show us the sponsor page.
Up here in the right, you could go to our sponsors. This is where you'll find
all of these organizations are make it possible for us to put this program together. And they're just, you know, I was in a session yesterday, and somebody in the audience said that, you know, money is the root of all evil. And I pointed to this particular page of all the good things that money can do. So I encourage you to, we're agnostic as far as a charity is concerned, but we think it's a great idea to be involved in a charity or to give to a charity through your will or trust. And there's some great, what they call planned gifts that you could then, that Lindsay kind of showed you on the website. Anyway, let's go to our presenter.
Thanks, Pete.
Thank you, Eugene. Hello, Delia.
Nice to see you.
It's good to see you. Delia was the first presenter that I had when we started this at Long Beach State University back in the 90s. Do you believe that?
It's pretty amazing.
You don't look a day older, by the way.
You're very kind. We look great, don't we?
Anyway, you've been around the bush, as they say. You know, you've been in business for how long now?
30 years.
30 years. How you're a fiduciary.
Yes, sir. Every day,
you know,
all the time.
Yeah, you do what's best for the client, not only morally, but also legally. And you are held to that liability standard.
Absolutely.
Yeah. Talk a little bit about your practice.
I am a fee-only financial advisor in Los Alamitos. I specialize in doing a combination of either assets under management or hourly assistance, so which makes me a little bit different than some advisors. And I have a subspecialty in working with government workers. These are people who might have a government pension like CalSTRS or PERS or LACERA or a federal pension. And they may or may not also have Social Security. And they're going to have some retirement accounts that are just a little bit different than other people's and have some different rules related to them. They might have a 457 plan, a 403B plan, plus a 401k plan, and how they can maximize those plans for their benefits.
Well, I'm going to just, why is that important for a client to know?
Because if you want expert help in your area of finance, you don't want to train the planner on how your system works. You want to be able to call somebody and say, I have CalSTRS and I have Social Security, but I might be affected by the windfall elimination provision and the government pension offset provision. And your planner ought to say, I understand.
Yeah. Yeah. So it's great to have a conversation with. I always suggest do at least 3 individuals who are fee-only fiduciary. It's kind of like a marriage. You want to be there for a long time. Approximately how many clients do you have?
You know, when on the management side, I probably have about 50. And on the hourly side, I probably see 3 or 4 clients a week.
Do you have a minimum?
No, but I find in terms of costs that it's probably best if somebody comes to me for assets under management with at least about $250,000.
And what is that fee for $250,000?
It typically starts at about 1% a year, and there are breakpoints after $500,000 and $1 million.
And do you work on an hourly basis?
On the other side of my business, I also can give hourly advice.
And then what's your hourly rate?
I charge $350 an hour. And if we're doing a financial plan, I like to get your information at least a week ahead of time. And I charge $150 to prepare.
Okay. Do you consider yourself an active or a passive manager?
Pretty much passive, because I don't believe that there's proof that we can beat the market. So why not buy the market? And besides, that's where I get the most bang for the buck for my clients because the fees are the lowest.
Yeah. Do you offer a free initial conversation to review a client's portfolio?
Yeah, if a client wants to come in and talk about how we might work together, we look at their investments, absolutely. Sure.
Yeah. And by the way, you know, the wonderful thing about that first meeting is you may not want them as a client.
Yeah, it goes both ways, doesn't it?
It goes both ways. Exactly.
Yeah,
it's a marriage, you know,
yeah.
It's but the hope is that they'll be there for 10, 15, 20 years. And speaking of that, you know, do you have a succession plan in your practice?
I do, although it just really depends year to year, you know, because you got to update it every year, just like any kind of plan.
Yeah, exactly. Okay, let's get on to the program.
You want to start with the ask first?
No, we just did the ask first. So
all right, good.
And it's online for anybody to review. So
that sounds great.
Yeah. Okay. So we're going to be reviewing some of the things that we talked about already in the past, but hopefully we'll refocus.
Exactly. Okay. So you see my screen?
No.
Maybe I need to be made co-host.
I don't know.
No, Pete, I could see that the screen is shared.
Oh, okay, great.
Oh, okay, good. So everybody can see my slides.
My side is messed up.
This is the, as you said, this is the final financial planning. And my information is on the second slide.
Okay.
So we've already gone over the ask first, and what we're going to do is do kind of a wrap up of everything that you've been discussing this session, these series of sessions. So the importance of putting together a plan, net worth, insurance, just touching a little bit on estate planning, but you cover that in another session. 529, saving and investing and retirement issues. So we know, and we've been stressing through this program, that financial planning is a process. The planner puts you through certain steps. If you're doing this at home, you put yourself through certain steps. What do you want to accomplish? What are your priorities? Where are you now? Where do you want to go? The planner is going to put together some recommendations and then present the plan. Once we figure out what's going to work best for you, we make the plan happen. That's implementing the plan. That can be investments, or you go to your insurance advisor and get better insurance. You go to an estate planning attorney. And then the important part is to monitor and update and adjust. Things change.
Yeah, they do, don't they?
And I know Pete and I both believe in starting with a net worth statement. You need to know what you own and what you owe, what you ultimately own in a net worth, because this is where every planner starts in figuring out what's the best path for you.
Yeah,
You
and
have
even for yourself, you know, you
And-
got it's if you don't, by the way, if you don't know how to put together a net worth, do not feel bad. When I was at Long Beach State University, I mean, most of the professors had no clue how to put together a net worth statement. Do you find that true for your initial clients?
Yes, it's absolutely true. You know, a lot of times people will put together a list of what they own and what they owe, but they won't net it out. They won't subtract what they owe from what they own.
Or
I
they
think is
forget to put
interesting.
an insurance policy in there, or they don't include their retirement plan, or they forget about their vacation home or their present home. Is your present home part of your investment net worth?
Absolutely. And it could be one of the first things you could lose if you're not adequately insured on your auto and your homeowners.
So one of the first things you do is to find out, what insurance do you have? What do you think of
Exactly.
everything that's going on in the homeowners insurance area today?
You know, this is so sad because I think that government is going to have to come to some agreement on how we're going to cover these extreme risks. Whether you want to say it's due to climate change or whatever it's due to, we're having more fires, more hurricanes, more floods, and individuals have to be able to afford to insure against that. We
Yeah.
can't lose our home and write a check to buy a new one. Most of us can't.
Yeah.
So
I've been hearing in the workshop series that number of insurance policies have been canceled.
number have been canceled, even in the rich areas of California. I know that there's a big list of companies that are going to raise their rates in California this year by sometime around September. So we should all expect a rate increase. But I think the insurance companies in California are playing chicken with the Department of Insurance. They want to raise the rates saying, listen, we need to be helped with this coverage for fire. And I believe what's going to happen probably ultimately is California will go the way of the earthquake coverage. We now have one big earthquake authority that covers earthquake in California, and I think we'll wind up having that for fire as well.
Yeah.
But that means all the more important that we put together a net worth statement to realize what we own and what we could lose, and then look at our insurance to make sure it's adequate.
Yeah. We reviewed it. Okay. There's been some major changes in are you going to talk about a little later the college 529 plans?
I am.
Okay.
I am.
Because there's some big changes there.
Exactly. So what I always like to make sure of is, and I'm sure you've heard this earlier in the sessions, take a look at your net worth, figure out what you have to lose, and make sure you have adequate auto and homeowners insurance. And if it doesn't cover your net worth, if your auto liability and your homeowner's liability don't cover your net worth, then you talk to your insurance agent. You probably are going to be a good candidate for a third policy. And that's called an personal umbrella liability policy. A lot of times we just call it an umbrella, and it's sold in $1 million increments.
And it's cheap.
And it's cheap. You know, if you had 2 cars in the family, could cost you like $450 a year, $450 a year.
Yeah. So you may have to change companies, or, you know, because they want you to have both your auto and home with the same company. But
That's
checking,
exactly right.
yeah, and and you don't have to have the exact same amount as your net worth. What the primary benefit of an liability policy such as this is that it pays for legal fees.
It's 100% legal defense.
Yeah,
And
and
I'll tell you, I have seen people going around $5 million net worth a couple of weeks ago. He had like $100,000 of liability coverage on his auto and home. I mean,
yeah,
it's just crazy.
yeah, and it's a good idea because the legal fees is what's expensive, and insurance companies do not like to pay out. At least on this one, they're on your side.
Yes, they are. They're definitely on your side. So that personal umbrella liability policy is really critical for a lot of my clients, particularly as we get closer to retirement, we have a lot more to lose.
Yeah.
And house prices have gone up like crazy. So
Yep. Let's go to the financial. Have you passed already the financial planning process?
yeah, we started out with this.
Yeah. I'm a little behind, Delia. Sorry.
Oh, no, that's fine. Can you see my screen?
Yes, I
Okay,
can.
perfect.
Yeah. Talk a little bit about goals, because people tend to kind of say, oh, I know my goals, but talk about how important they are.
They're so important because if you really want to make your plan become a reality, you need to be very specific. So sometimes people who are getting ready to retire will come to me and say, well, I want to retire comfortably. And I'm waiting because the financial planner hasn't heard what they need yet. Oh, I want to retire in January of 2026, and I'm going to need $6,000 a month after taxes from my investments and other income. Now I hear you. Now I have a goal that I can work on.
Yeah.
And frankly, you have a goal you can work on too, because a lot of times we can't retire with the same amount of income that we had when we were working. A lot of times something has to change. It might be that our mortgage is paid off by then, or maybe we've started Social Security, and so that's a blessing. But you need to be able to put a dollar amount on it. And a lot of people don't think that way. They've been living on their income and it's been working out and they don't think about it. But once you retire, now things have changed. And we need to put pen to paper and figure out what those dollar amounts are.
Yeah, and people's biggest fear is running out of money.
I don't blame them.
But they never do the numbers.
They never do the numbers. I mean, the good news is we're living longer, but the bad news is we're living longer. But let's put those numbers down and take a look at them.
And so consequently, a lot of individuals try to even save more in retirement.
That can be a problem as well. I mean, I have had clients that I've looked at and said, listen, you could die with $5 million at 95 years old. Why don't we front load some more travel? Why don't we have, let's fix up that kitchen or do the bathroom that you wanted to do?
But that's another reason why that net worth statement is so important, because not everything goes down in value every year or goes up in value every year. But a net worth statement takes in your house, your stocks and bonds, your everything that you own. And
that's exactly right.
People are surprised that even though they may have had a bad year in the market, so to speak, but their net worth is up.
They're very surprised. It's often when I pull up the net worth statement and after looking at their information for quite some time, they say, oh my gosh, I didn't realize that.
Yeah. And that's, and people die or people get sick or, it's not a static relationship. That's why you can't have 3,000 clients.
No, you can't. No, you just can't, because people are calling me all the time to update their plan, even if they've seen me 5 or 7 years ago.
Yeah.
They call me and they say, we need an update now. Something's happened. I got an inheritance, or we bought a second home, or our kid
wants to borrow money.
My kid wants to borrow money. Oh my gosh, absolutely.
It's or I need caregiving service.
Yes. And once people see somebody in their family go through that, now they're focused. Now they realize what it really entails, and they want to talk about how they would pay for their own care if they needed it. And they're looking at their 2-story home, wondering if that's the best plan.
Well, what happens a lot too is that there usually one person in the family who takes care of the financial assets. And if that person becomes incapacitated or dies, the partner who hasn't been involved all of a sudden now has to learn all this stuff. And so from my point of view, that's why it's so important to keep this ask first sheets of our presenters so that their surviving partner can seek out someone for help.
And I've had people come in for plans just to, oftentimes driven by that one partner who does the financial planning. And they say, I want us to look at this together. I feel we're fine, but I want to make sure that my partner's spouse knows that, and that they have somebody to call on if something happened to me.
Yeah. I was also, you can never give your kids advice, but you can have your kid go to a fee-only fiduciary advisor for a plan.
Yeah, I've often been, my services have been gifted to kids.
Yeah.
That's true.
Well, they're not going to listen to me or to you,
That's it.
your own kid, but they will listen to an outside authority.
That's
Let's go back
exactly.
to the risk management slide.
Sure.
Health insurance. Wow. Huge. Every year you have to, you can make a change.
Yeah, every year you have choices. I know you had a session on Medicare, which is great because a lot of people's approaching Medicare age or even in Medicare age are not quite sure how it works.
Yeah.
And they need to know when that's coming up, what that's going to look like, because it's a whole other world.
Yeah, I think if you scroll down a little bit on your slide, you have you got the health insurance, your homeowners, long-term care. Do you see many individuals having long-term care policies today?
Probably about 20 or 25% of them do.
Yeah.
Not a great many. And a lot of times it's been because they've been priced out, or by the time they went around to look for it, they realized they needed it. They couldn't qualify for it anymore.
Yeah. If you do have a long-term care policy, not the HAPS clinic, what's the name of the organization? And I'm trying to think of here in Orange County that handles senior affairs. I can't think of it right now. But anyway, there are some help out there. Make sure that you keep
ICAP, maybe.
HiCap. Thank you, Delia. And HiCap is a wonderful organization.
Great organization.
They'll review your long-term care policy for you, and they'll do it without charge. They won't make recommendations, but please keep that long-term care policy with your estate planning documents.
Oh, absolutely.
Talk a little bit about life insurance.
People sometimes have life insurance policies that they don't look at, they pay for them, but they're not quite sure if they're still good policies or if they're still a good fit for them. And sometimes they say to me, especially if it's a life insurance policy that's built up some cash, they say, well, I'm just going to shut down this policy and take the cash. And I'm like, wait a minute, a life insurance policy is like an investment account if it has cash in it. And it might be that there are things you could do with that policy that would help you long term. So for example, you might be able to take that cash, buy either paid up insurance, life insurance that you don't have to pay into anymore, or you might be able to transfer that value to have a long-term care rider on it. So you should look at a long-term care insurance policy, a life insurance policy with cash value in it, as an asset that you want to be very careful about and get good advice on before you just cancel it and take the cash.
What about life insurance policies? I mean, what should people be doing there?
Well, life insurance policies, if they do, even if
I'm talking about somebody who's retired, the kids are out of the house, and they're still paying on a whole life insurance policy. Do
Well,
you review those?
we have to, sometimes I do. We have to figure out if they still need it. It might be that they could sell it. It might be that if it has cash in it, that they could use it with an agent. They could talk to an agent and actually switch it over to a kind of a life insurance that has a long-term care rider on it. So that life insurance policy should be seen as an asset that you have to be very careful about before you make any changes.
Okay.
Or they might be able to donate it to charity.
That's a good thing too, you know. Yeah, I find people kind of, once they just kind of go ahead and keep on making the payments, and they don't really understand their life insurance policy.
Yeah, I see those people a lot.
Yeah, yeah. So it's a thing to review. We talked about the umbrella policy. We talked a little bit about how much you need, how much is enough. So that's related to the net worth.
That's exactly right. So in the case of this client in front of us, they have retirement accounts that certainly could be protected from the bad guys. So if we feel that they're protected from any kind of lawsuit, if they got in a car accident, it might be that we don't need to cover their entire net worth of nearly 1.2 million. Maybe we're just looking to protect about 900,000. But even then, it might be that that umbrella policy would really come in handy because, frankly, home values are going up. And so the house that looks like it's worth less than $1 million today might be $1.2 million in a couple of years.
Yeah. Yeah. Well,
So,
you know, the good news on the next slide is getting more for your savings.
yes.
You know,
Yes.
this is good news and bad news in a way, but I think it's more good news for us who are above 70.
Exactly, because a lot of people who are retirees are people who have very little, if any, mortgage, and they're looking for more money on their savings. And frankly, for the first time since about 2008, we're getting these kind of interest rates. We can go to online FDIC insured savings accounts and get in the 5%. There's an organization like Max My Interest that will move your accounts around to savings accounts to make sure they make more money. There are money market funds that we can buy at brokerage firms or like at Vanguard that are paying at least 5% right now. This is a wonderful time. Or you could buy US Treasuries or even CDs through a brokerage firm. And for this example, about a week ago, you could get a CD for 3 months for 5.459, or a US Treasury bond, which, by the way, is free of California income tax, for just about the same amount of interest, especially if you didn't have to pay California taxes on it.
Yeah.
These are good times.
Yeah, I'm getting more away from working with banks and working more with discount brokerage firm, primarily Schwab. And because they have a checking account, they have money market accounts, they have offices in the local area. And by the way, I'm not getting paid by Schwab to promote them. But you know, to have your accounts electronically in a brokerage account is the way to go. Don't have individual bonds, but in paper form. Don't have stock certificates in paper form.
Or accounts of transfer agents where they're not consolidated.
Computer share. Open up all, as you get older. Consolidate. Keep things simple so that you get one account statement or at the most two.
Your beneficiaries will appreciate it.
Yeah, it's just not only because you can understand it better and you want low cost, and you don't want to be hammered by emails and commercials and that type of thing. So,
well, and Pete, I don't know if you see this or not, but I'm seeing more and more clients who are trying to settle families, estates, And the banks are not as sophisticated as brokerage firms about settling estates. They're just not.
They're not. And, you know, so which we talked a little bit about knowing your net worth,
Yes.
but know how you have each asset titled.
Oh, yes.
You know, it's really important. You know, and you can Vanguard funds is, I think, for individuals are probably one of the best if they want to do it for themselves and invest. What do you think, Delia?
Yeah, Vanguard is well known and has deserved reputation for extremely low fees inside of their funds. Fidelity, when they're trying to compete at the same level, like an S&P 500 index fund or something like that, Fidelity goes head to head with Vanguard. But Vanguard overall consistently has the lowest fees.
Yeah. The thing I don't care for Fidelity as much is that they sell annuities. They sell mutual funds. They offer no load funds and the like, and they're a discount brokerage firm, but they have a lot of things that they sell.
Oh,
So
absolutely.
I tend to go through Vanguard, and you could set up a Vanguard account through Schwab.
Yeah, you can buy Vanguard funds through Schwab, Vanguard exchange traded funds for no cost. They do charge for the mutual funds $45 to buy them and 45 bucks to sell them.
Yeah. And
But
then what is a brokered CD?
this is just one that you buy through a brokerage firm, and you can trade it, meaning you can sell it before it matures without any interest penalty. You get it through the brokerage account, so we call it brokered CD. But what you have to realize is that when you sell a CD, just like if you sold a bond before it matured, you're selling into today's market. And if interest rates have gone up since you bought it, you might not get the price that you want when you sell it. So it can be convenient for people who want to park money in CDs and hold them to maturity. It is probably not the kind of thing that you want to sell before it matures, unless you feel confident that you're going to get the price that you want.
Yeah. We're going to talk a little bit about asset allocation, but can we just jump a little ahead on, don't go there right now, but we have Vanguard on the screen.
Yes.
Vanguard offers life strategy funds. What do you think of those?
I think that they can, if people look at them and see that it fits their goals and objectives, they can be ideal, because what the Life Strategy Fund does is it says, listen, we're going to give you a moderate allocation of stocks and bonds. And when you open up, when you look under the hood of that moderate allocation fund to see what it owns their index funds from Vanguard. And not only do they put them in an allocation that is moderate allocation, maybe 60% stocks, 40% bonds and cash, but they keep it in balance. So you don't have to go in and change it at all, because if stocks grow bigger than the 60% to hit 70%, they sell off some inside the fund and reallocate for you. You can hold one fund in an account as long as it keeps meeting your goals, and that fund will do the job for you.
Yeah.
It's ideal.
Yeah. So one of the things that about the workshop series, we're not trying to drive you to a financial advisor. So you can do this yourself, keep it simple. And there are, like Vanguard, ways to do that. You can also, like say with Schwab, tell Schwab, hey, I'm used to getting a paycheck. And so can you send me $10,000 per month to my bank account? Will they do that?
They certainly can. They're going to need you to have cash available to do that, but they'll put together that kind of automatic withdrawal for you.
Yeah.
It's
so you
really handy.
Yeah, make it look like, you're still working and you get an automatically paycheck every month or every 2 weeks or however you want to have that money transferred.
And it's a great strategy to transition from the working world to retired world. I mean, I have clients who've been used to getting 2 checks a month, and I put together their withdrawals so they get them on the 1st and the 15th,
Yeah. Yeah.
what
So
they're used to.
yeah, you can make it easy for yourself. So, there is no secret sauce out there.
Yeah.
There's, it's brokers are there to sell stuff, and you don't need a broker. And we haven't talked about this. Do you have it's so important to look people up. Where broker check? Do you
Yes. Yeah,
I forgot
broker
to
check.
mention that earlier.
I think we do it in the first financial planning session.
Yeah, but
Yeah.
remember, this is the kind of a review.
It is. So
Look your
everybody
broker up.
needs to know that they can go to brokercheck.org and look up their advisor.
Yeah, everybody should be able to be found and and find out who they are. Not just that they're a nice guy. Let's go to the next slide.
Okay. And this is what you would ask for, that for a lot of us, whether it's whether we still have children or we're trying to help out grandchildren or nieces and nephews, a 529 plan is a great way to save for college. The beauty of it is that if you're going to ultimately use that money for approved education costs, the money grows tax-free. You can withdraw it tax-free. And there are now a wonderful selection of 529 plans or 529 plans. You can do it yourself. You can check them out at savingforcollege.com. Vanguard has a 529 comparison tool. Utah has a wonderful 529 plan that uses Vanguard and DFA funds called My 529.
So you can use any state's 529 plan.
Yes.
Even though you live in California?
That's exactly right. You can live in California, use Utah's plan, and the kid can go to a school in Missouri.
Okay.
I mean, it's great.
And what if they don't go to college or don't use it?
Well, you can do a couple of things with it. You can send it to another family member. You can transfer it to another family member. You can transfer it to yourself and you use it for college or school. You could use up to $10,000 of it towards student loans, or you can now use it for private K through 12, and you can use it for any school that qualifies for federal aid. So if your person wants to go to chef school and that chef school qualifies for federal aid, then you can use it for that.
Yeah. And even if there's money left over, you can even transfer it now to an IRA account.
That's exactly right. And that's my next slide. So
Yeah.
if the account has been open for 15 years or longer, you may convert up to $35,000 during a lifetime to a Roth IRA for that account beneficiary. The transfer every year is limited to whatever the annual amount is for that year's contribution to a Roth for that age group, for that person. And they have to have qualifying earned income that year of the rollover. But what a great way to get somebody started on a retirement account. I mean, and this takes care of that argument of, I don't know if I want to put too much in a 529 plan because maybe my kid's not going to use it or not use all of it. What a great idea.
Yeah. Yeah.
So,
you have the 529 able accounts.
this is very important for people who have anyone in their circle who has any kind of special need. These are individuals with disabilities. Maybe they're not going to be able to support themselves like you and I have been able to. If the disability happened before age 26, we can make a contribution every year of up to $18,000, and you can transfer that amount from a regular 529 plan into a 529 ABLE plan. You know, more and more people are learning about this. I've had more and more parents of autistic and other children who've come to me and said, you know, we're setting up a 529 ABLE account. So that's really good to know. And the beauty of these accounts is that anything up into that account is not going to affect that individual's eligibility for all sorts of benefits: Social Security and disability insurance, housing assistance, Medicare, A, B, C, D, or Medicare savings, Medicaid benefits. The list goes on and on.
Yeah,
So people need to know about this.
absolutely.
You've had a session, it's your estate.
But it's worth going through it again. You know, these documents need to be there.
People need to know, if you don't own real estate in California, and if you don't have minor children or other special needs people to take care of, maybe you don't need a trust, but there's
Maybe
certainly
not.
3 key documents that you need.
Will, durable power of attorney, and the advanced healthcare directive. And you can get most of those absolutely for free if you need to. We recommend, if you do own property, please see an attorney.
Please. Please.
And I don't find this happening enough, but people put too much confidence in their attorney knowing financial information. You know, I hate to disparage a particular group, but attorneys do not know much about money.
Yeah.
So involve your financial advisor in your planning. Who are you going to name as executor? Who are you going to name as the attorney in fact to handle the finances? Your fee-only advisor will be a great sounding board if you're having trouble figuring out who in the family I should name. You know, I suggest many a time that the attorney visit the financial advisor's office versus the other way around. A professional fee-only advisor can help you with maybe be what's called a trust protector, someone who helps pick the next successor trustee. There's all sorts of things that a fee-only advisor can help you with in your estate plan. I also remind you to review it.
Yes.
You
I've
know?
had a couple of people come to me recently that there's a house to be inherited, and they didn't realize the complications of whether they would be able to inherit mom or dad's property tax base because of how many people were in line to inherit the house.
Yeah, well, you got Prop 19, which is brand new. You've got the step up in basis, which is well, it's not brand new, but it's been around forever. When to gift? You know, should I wait to gift this at the end of my life, or should I gift it during my life?
And what should I gift?
Yeah, tax decisions, you know. So people think of the estate plan as a death plan. No, it's actually during your lifetime.
I have helped several clients who were still alive. Their children came in and were managing the money in the trust because parents were maybe in a facility or housebound and they could no longer make those decisions.
Yeah, yeah. In fact, the next slide talks about retirement planning.
Exactly. Now, maybe a lot of our viewers are already retired, but you know, starting with that net worth statement, how much will you have? Not only what you have now, but will it grow? How much will you have in terms of Social Security or pensions or annuity income? Maybe you did do a gift annuity and you've got some money coming in.
How much will you need? How do we figure that out?
Well, it can be difficult because sometimes people don't think about what it costs them to live today. So sometimes we have to go through paychecks and figure out what their net checks are, but the kids will be out of the house. Maybe, if they're lucky, that the kids will be successfully launched. But what if they aren't? Or what if you have a special needs kid that you're still supporting? And certainly they want to put into their budget money for travel and entertainment and fixing up the house. There's a lot to consider. I mean, it's kind of rebuilding your financial life in some way.
Yeah, because all of a sudden you're not getting a paycheck, not getting taxes withdrawn. You know, taxes are just huge in a financial plan once you're retired. You know, you want to keep that adjusted gross income to the level of what you need to spend.
That's it. And maybe you should be considering some conversion of some of your retirement accounts to Roth accounts. You know, maybe you should be taking money out of retirement accounts sooner, as long as, you know, if you're in a lower tax bracket.
Yeah.
Because maybe you're going to wind up in a higher tax bracket soon, particularly when you start taking out required minimum distributions from your retirement accounts.
Yeah. It's just if your financial advisor has not asked to see your tax return, they're not an advisor. They're a seller of stuff. They need to understand your tax situation. And everybody's inflation is a little bit different. They're not,
Absolutely.
it's not the same for everybody. If you have a great medical insurance policy, your inflation is likely going to be lower. You know, if you already own your home and it's paid off, you know, you're likely your inflation number is going to be lower. So when we do what if calculations going forward, the numbers that you use are really important, especially on the long term.
And you have to remember too that things can change. I have a client who suddenly had to need a new medication, and that's like $1,000 a month.
Yeah.
Was not in their original plan. Well, of course, things change.
And that's another reason why every October you check with an insurance agent, because the commissions are the same across the board. So you want an insurance agent to review your prescriptions to see what your insurance company will pay on that prescription. And that prescription payment changes every year, even in the same insurance company.
Yeah.
So you want that insurance company who will pay you the most. So don't fall in love with your insurance provider. Find out what prescription costs are, because as Delia said, some of these prescription prices are going through the roof.
Absolutely. They're going through the roof, and your situation may have changed. I mean, I have family members a couple of years ago who were perfectly healthy and fine, and then they both got cancer diagnoses in the same year. Now they're fine now, but suddenly their prescription situation changed completely.
Not only that, but everything else changes.
Mm.
You know, because you're totally focused in on the cancer care.
Yes.
You know, you need help. I do manage my own money. You know, many of the fee-only advisors don't manage their own money.
Sure.
You know, it's anyway, how much can you spend? That's a biggie, isn't it?
That's the big one. What can you afford? And, you know, we can run best case, worst case, most likely case. If you don't have long-term care insurance, which a lot of people may not have, what if you needed care? We hope, you know, maybe just for a very, very short period of time at the very end of your life. But could you afford it? How much could you afford?
And the thing of it is that's another reason why you have a home, and there's some, you know, in the event that you need a reverse mortgage. By the way, most of us will not need a reverse mortgage because it's debt. The last thing you want to have as we get older is debt. So, but I'm glad it's there. It's a tool that we may need to take advantage of to pay for long-term care.
That's exactly right. That's exactly right.
How should you invest to meet your goal? That's a good question. How should we? Can you give us a 5-minute answer?
Yeah, well, you need to take the dollar amount and a time frame. So I have clients who have a pool of money that they're thinking about using to buy a house. Well, we're not buying stocks and bonds with that. We just bought, you know, some very short-term US Treasuries and a big money market account. And they just wanted to get more interest on their money while they're shopping for a house. That's very short-term money, right? They could need it at any time. But if there's a portion of your money that you can invest for the next 6, 7, 8, 10 years, the second half of your retirement, then maybe that money you could afford to put some in stocks. But again, we'd have to take a look at your risk tolerance, your bigger picture of what else you have invested, what your other income sources are. And sometimes people don't want to take the risk of investing some in stocks, even though it might help them beat inflation. So we have to look at what the individual needs. We have to look at a dollar amount and a time frame of when they're going to need certain money. We have to look at their options and determine how comfortable they feel with those options.
But that's why you have to always go back to your goal.
That's
What
it.
is your goal? You
Yeah.
know, what are we trying to accomplish here? And that's why having goals written down is really helpful, even for yourself. We forget as to why we purchased what we did, you know, and especially with Social Security and Medicare, you know, those things become taxable at a certain point.
Yes. Yes.
You
Although
know,
luckily
Medicare
California
premiums
doesn't
go
tax
up
it.
if you
Yes.
have more, if your adjusted gross income goes up.
Yes, they look at 2 years previous to what you were making, you know, what this year was. They do a look back 2 years and say, oh, you made more than we expected. Your premiums are now higher for this year.
Yeah. So knowing your tax bracket is really important.
Absolutely.
You know, we haven't even talked about RMDs, required minimum distributions, and you know, it all has to do with your tax bracket.
Yeah, people will come to me and say, well, retirement looks pretty good. And I'll say, well, let's take a look at when you start required minimum distributions. And there might be another $80,000 to $150,000 a year in income that they have to take, and they have to pay taxes on it.
Yeah. If I had to guess, I would say our tax rates are going to increase in the future. So if you are in the 22% income tax bracket, you know, you may want to make sure you fill that bracket up. So you may want to take out more than your required minimum distribution.
That's
You know?
exactly right.
And do we have a slide on QCDs, or do we go?
Yes, we do.
Okay, well, no, I'll hold off, but let's just go to your next slide.
Okay, so let's take a look. I wanted to remind people that if you're still the retirement planning resources that you may have, the income resources, maybe you could get an inheritance. If you're still working, you qualify to put money in retirement accounts. I had somebody who called me, she'd been retired for 6 years, she was still putting money in a Roth IRA. I said, wait a minute. She goes, well, I've been good. And I said, no, because you're not working, you don't qualify.
Yeah.
So know that there are contribution limits based on how much you make. It's good to save towards a future goal, but if you're already retired, you can't contribute anymore.
And also the IRS is not the heartless agency that sometimes they're portrayed to be. So if you made a mistake in the past, you're much better off writing to the IRS saying, hey, I made a mistake. This is my mistake. You know, what do I do and how can I correct it? And they'll help you do that.
As soon as I figured it out, as soon as
it's not easy, you know, it's complex.
There's a lot of moving parts.
Yeah. And it comes with the less you have, the more simple it is. So just as your wealth grows, we in Orange County here, having $1 million estate means that you have a nice car or an adequate car and maybe a house. You know, it doesn't take much. We live in a very fantasy world. We're not Arkansas or Kansas. This is a unique area. So I would say for us here in Orange County, we probably need more sophisticated financial planning than maybe someone in another state or another locale that is not as high priced.
Exactly. And remember why we invest. We invest because we want to beat inflation, and we have time, we have the power of compounding. And
Yeah.
even if you're retiring today, you could be living for another 20 to 30 years.
Yeah.
So you're saving for that 90-year-old, you're saving for that 95-year-old.
That's why you want some portion of your portfolio to be in stocks.
That's exactly it.
So go ahead.
Over time, the amount that you need to save to reach a future goal is smaller if you start earlier. Now, a lot of us may not think we have 40 years left, but we certainly might have 20 years left. And it's better to start saving earlier for a goal. And there are various nest eggs amounts that we need if we're going to try to sustain certain spending levels. So it might be if you get a rate of return on your retirement accounts of 5%, and you want to get $100,000 a year of income out of that, you may need to start retirement with about 2.3 million. But this is why planning is important. What's inflation going to be? How much are you really going to need? But what happens when Social Security kicks in or your required minimum distributions? There's a lot of moving parts.
Yeah.
And we know that Social Security is based on how long you've worked, the numbers of quarters that you've paid in. And the beauty of Social Security is that it goes up with inflation every year, if we've had inflation. Some people want to take it sooner because they feel like they worked and they deserved it, but it's going to be the only benefit that's guaranteed to increase for you if you wait. Between 62 and your full retirement age of 67, it can go up 7% a year. If you wait between 67 and 70, it goes up at 8% a year. Now, today, if you were going to retire this year, here are the maximum Social Security benefits you could get every month at different ages. 62, full retirement age of 67. If you waited until age 70, look at that compared to age 62. That's a lot of money for who you're going to be when you're 90, 91, 95.
Yep.
It's a beautiful thing.
Most of our attendees are already retired. So
exactly.
But encourage others,
Absolutely. Encourage everybody you know in your family.
Yeah.
So if you're just on the cusp of age 70 or 72, you may not realize that you don't have to start required minimum distributions yet. You could wait until 73 or 75. And this is because of some changes in the law called the Secure Act 2.0.
Yeah.
And this is for required minimum distributions. There are calculators out there for free. There's a site called dinkytown.net that I really like. And you can get all sorts of calculators out there. This is one that is a link to a retirement calculator. Now, I think that there are some assumptions that you have to make about your goals and objectives, inflation, a rate of return, a lot of variables that you have to think about. You can play with these calculators, but if you really are coming down to a big decision for retirement, I would really encourage you to check in with a professional and make sure that you could polish this kind of plan.
Yeah.
So
most people think that a financial advisor is just about investments. It's about number crunching, and so I could see why you pointed up a calculator, because that's what you do,
it makes people cross-eyed a little bit to think about all these variables.
Yeah.
How old are you? When are you going to retire? What are you going to have coming in? What are you going to need? How much are you saving?
Yeah. A good advisor is one who crunches the numbers for you. You
never offend us by bringing in numbers.
Yeah, never.
We're always very happy to see spreadsheets and statements and documents.
Now we're going to talk about investments. So what do you mean by this slide?
Well, this shows that a lot of times people's spending changes over their life expectancy. So it might be that when they first retire, they're spending the most. And a lot of people tease that first third, that active phase, or the go-go years. And then it might be that you actually don't need to spend as much in the middle years. because you're more staying at home. Maybe you have grandchildren nearby, although you might be tempted to spend on them. And these might be more a slower go years. And then in your last third of your life, you might be spending more on healthcare. So you may not be going in terms of travel, but you may have quite a few expenses, especially for long-term care and other health costs. So another way to look at this is to stratify your investments, structure a portfolio to match your goals. So at the very bottom of this pyramid for stable spending, this is where you want to make sure to look at your Social Security, any pension you might have. If you have a gift annuity or some other kind of annuity that you've turned on a regular payment, does that cover your expenses? It might be that you have some variable expenses that you still need to have money every month. That money needs to be someplace really safe, but it might be a pool of money that you would tap. It might be dividends from stocks or interest payments from bonds. And then for that money that you want to leave to somebody, if you want to leave an inheritance, and a lot of people say, well, charity begins at home. But if you wanted to leave an inheritance, that would be longer term money. I have some people say, well, I want to leave this Roth IRA to my kid. And I'm like, how old's your kid? Well, they're 35. Well, we can invest for growth. We can invest for growth in that Roth IRA that you'll want to leave the children. Why not? And so another way of structuring your investment ideas and your goals and objectives is to look at it at kind of a linear way, that you need reliable income for that money that's for essential expenses. So again, that reliable income, the money that's at the bottom of the pyramid, Social Security, pensions, income annuities, maybe a bond ladder, that's for what you need day to day. If you have some discretionary expenses, like you want to travel this year, or you want, maybe I'm going to go buy myself something, maybe that comes out of your portfolio. And if you're having a good year, you spend a little more. If you're having less of a year, maybe you spend a little bit less. And that's also where legacy, you're going to leave something to family or to charity or other loved ones, comes out of your investment account. And then at the very bottom, we all need an emergency fund. And that can be cash value in insurance. It could be equity in your home, as Pete said. That's where a lot of my clients tap their home for any kind of long-term care. And sometimes people have the bank of mom and dad still, and they may turn to the bank of mom and dad. A lot of my clients are the bank of mom and dad.
Yeah. Yep.
That's who my clients are. And then Pete, you pointed out, boy, qualified charitable distributions or QCDs make clients so happy. If you give money to charity and you also need to take out required minimum distributions from your retirement accounts, you can get credit for that required minimum distribution by giving money directly out of your IRAs to charity. IRAs, not a 403B, not a 401k. I hope they'll broaden out those rules. But right now, that money needs to be in an IRA. So some of my teacher clients and other government workers who have 403Bs and 457 plans, if they'd like to take advantage of this, they need to move money into the IRA and write that check out of an IRA.
Yeah.
And then there are these great one-time opportunities to use a max of 50,000 as a QCD to fund. I think the idea of using it for a charitable gift annuity is the simplest and the most
charitable gift annuity is a 2-page contract that pays you based on your age. And so many of your major charitable organizations will have a gift rate chart. So, and it's applicable to 98% of charitable organizations in the United States. And you could see what that rate of return is. And it's kind of a nice way, and it qualifies for your RMD for that year. Remember,
that's exactly it.
Yeah, your required minimum, you want to keep, like we said before, your adjusted gross income low, because your Medicare and Social Security benefits can be taxed, and Medicare premiums can be raised based on your income from 2 years ago.
Yeah,
So if you had a major sale 2 years ago, your Medicare premiums are going to go up dramatically 2 years from now.
that's it. It's called the income related monthly adjustment amount, or
You-
IRMA.
Yeah, you
We don't
got
like
it.
IRMA very much.
No, we don't like IRMA at all. You
But I
didn't
want
talk
people to
much.
look at this charitable gift annuity idea, because some people say to me, well, I'd like to turn some of my cash into a regular series of payments. And it turns out that doing it through a charitable gift annuity, the rate that they would give you, if you compared that to taking the money out of the IRA, paying taxes on it and buying an annuity, you're better off doing it through the IRA.
Yeah.
Much better off.
Yeah, and it's brand new. Not very, most advisors do not know about it.
Yeah, I think it's a great idea.
Yeah. We haven't talked much about asset allocation. And you want to say a few words before we go to the financial planning slide?
Absolutely. And I apologize for not having anything in detail on that, but you know,
What is asset allocation?
asset allocation is organizing your investments among different groups of investments, stocks or equities, bonds or income, cash, something absolutely guaranteed. And what is that mix going to be? Stocks give us more growth and protect us against inflation, but they're more volatile, which means they're more risky. Bonds will give us a regular income. They can be really handy that way, but they may not beat inflation, but they're going to give you purchase correctly and in the right mix, they're going to give you regular income. And then the cash, of course, is there. Right now, we can get interest on our income, but it's also there for security reasons. It's there for emergency funds. It's there to live off of.
One of the more important things is that on the fixed income side, Delia, are you putting people into individual bonds, or do you use a bond fund?
Well, I actually am using a mix right now because US Treasuries or CDs can be very handy to lock in today's higher interest rates. In general, I've been using bond funds because you have a professional manager who's always buying you a broader mix than any advisor could buy on their own.
So when you say to lock in a particular period, in the fixed income area, I think it's called duration, which is equivalent to when is your CD is going to mature. What in your bond portfolio for your clients today, how far are you going out as far as maturity is concerned? And where do you think the sweet spot is for today?
Right now, I think the sweet spot is keeping as short a duration as possible.
So 2 years is the max?
Maybe somewhere around 2 years, because we're not sure what's going on with interest rates. We can all pull out our crystal ball and say, oh, we think the Federal Reserve is going to lower rates. We can listen to the pundits, but you really don't know.
So if you own a bond mutual fund, one of the questions is don't look at the yield, look at what their level of maturity dates is, what's their average. Do you have anything over 7 years?
No.
Okay, so 7 years is absolutely your max.
Yeah, and that's pretty much where if you took the whole bond market, the aggregate of all bonds in the US, you'd have pretty much that aggregate bond index or total bond index would have that average maturity and duration. The average maturity would be somewhere around 6 to 7 years. The duration would be very close.
Yeah. But the sweet spot right now, what you're having most of your clients is 2 years.
I'm trying to stay much shorter. Yeah,
much shorter. And that's kind of where they look at in the fixed income area. In the equity area, we get all sorts of prognosis of what's best and what's not. You said yourself that you are more of a passive investor. So what do you look for when you look at a client's portfolio on the stock side?
Well, I want to see how it's allocated among large, medium, and small stocks.
So diversification
Diversification is
that's the
really
first thing you
important.
look at.
I look at style. Are they all growth oriented? We know those growth companies, Amazon, Microsoft, all of those. Or are they more value oriented, more financial companies and utilities? They may feel that they're diversified, but they don't realize that the style of the investment skews them in one way or the other. You know, owning a high-tech stock fund is not diversification. One stock fund that specializes in just one area of the market is not diversification.
Yeah. Do you have your clients in any kind of cryptocurrency?
No,
That was a
that was
quick.
easy. Do I have crypto? No.
Stay away. But how about people that think gold is a hedge against inflation? Do you have clients in gold?
I have clients, I don't have any, but I have clients who do choose to buy some, and if anybody's tracking it, it's done well this year. But the problem with gold is it doesn't throw off any income. I mean, you could own a gold producing stock that might pay a dividend. But there is a place in client accounts for real assets like oil and gas or commodities, which can include a lot of different things: precious metals, copper, aluminum, lithium.
Yeah.
I like to buy that in a diversified fund
Yes.
because
Do not buy it into a private partnership for
No.
oil or for real estate. It's very, as we get older, liquidity becomes really important. Talk a little bit about why liquidity, well, talk about the market, why buying it on an exchange for liquidity purposes is so important.
Yeah, that's an important term, liquidity. Liquidity means that if the stock market is open or the bond market is open Monday through Friday, 6:30 to maybe about 2 o'clock our time for bonds, I can go in and sell something. If I needed to sell it, I could sell it. The client could have their money in another day or so. That ability to go in and sell, to have that money is liquidity, that ability to go and grab those funds. I can't have something that's tied up for a couple of years in some private partnership and I don't know where the money is and I have to take the word for the organization of what it's worth. When it is in an open stock market, not only is it easy to sell, but I can go out and check the price every day.
Yeah. Yeah. And people do the 1031 exchanges with real estate. At some point in time, you may want to use this money, but the problem is the capital gains tax has been fully depreciated. And so there's a lot of programs out there that will try to minimize the impact of that, but most of them don't include a charitable remainder trust. So please take a look at that if you're trying to get out of properties that you want to turn into cash.
I think it can surprise people the benefit that they could get out of doing that.
Yeah. Running the numbers is before you make a major change. That's why our program is kind of called the no change workshop, because you want to know, what the cost of the change is. What is the tax impact of the change? What is my cost going forward? The thing that you can control is fees and expenses and a little bit on taxes, but you can't control the market.
You make a really good point. And I've had a lot of people come to me and they say, well, I'm going to buy some rental properties and then I'll just sell them if I need the money. And I said, well, but you have to recapture that depreciation. And they go, what? And I go, no. Before you get into an investment, know what it's going to take to get out of it.
Yeah.
Understand the tax implications.
The next slide is, we talked about financial planners, credentials. It's important. If they're, it's one of the things, if they're connected with a brokerage firm, check out the brokerage firm on FINRA. Besides the independent, for example, Delia, who do you broker your account through?
I custody client money at Charles Schwab.
And so that's the key word, custodian, right?
That's it.
And do you have any control over that account?
I have a limited power of attorney, so I can go in and see it. I can make trades, buy and sell. And if the client authorizes it, I can charge my fees against it or send them money to their bank account. Not to my bank account, to their bank account.
Yeah. And so, but you don't have any control over Schwab, how they
No.
put their statements together,
No,
et cetera, et cetera.
no. Then that's the beauty of it. You can go in independently and look at your account every day, all day long. And Delia's not in charge of it. I'm not in the back room printing up statements. Schwab's doing that.
Okay. Fidelity and Schwab now have in-house registered investment advisors. You want to make a comment as far as that is concerned?
Well, I think that if they're doing a good job, they're doing a very narrow job of investing your money. They're not looking at the bigger picture. I've actually had advisors who are only managing money say that they're not allowed under their house regulations to give a client advice on their auto and homeowners insurance or health savings accounts or QCDs. That's not what they manage, and they're not covered for that liability.
And they have approximately 200 to 300 clients each. So just, ask questions. For more information.
For more information, you're going to look at their credentials. You're going to figure out their experience and whether you have a rapport. And for more information, you can check out the Financial Planning Association for fee-only planners. You want to make sure that you screen them that way. Or we have an association of fee-only planners that you can go to.
And talk about the Financial Planning Association and NAPFA. NAPFA is my favorite.
Well, it's mine too, because we're all fee-only planners, but it might be that when you go to a NAPFA advisor and you say, well, how do you work? Can you do financial planning with me? It might be that they would only do that if you brought them money to invest. So you want to make sure to get to know the advisor, figure out if they provide services that fit your needs. The Financial Planning Association, on the other hand, is a mix of planners who may be both commissioned agents and fee only. So it is a very large professional association that has very nice educational standards, but you might not be getting a fee only planner if you reach out to somebody in that organization.
And you're a member of both?
I'm a member of both. I mean, I think that they provide value.
Yeah. And also, if somebody calls you, describes what they need, you will send them to someone if they just don't want to be
absolutely.
Or, help them through the process of picking out a fee-only advisor.
Absolutely.
And you don't charge for that, and you don't get
somebody calls me and says, here's what I'm looking for. No, I don't get referral fees.
Yeah, I know.
I say, if somebody wants to take me to lunch, anything I can eat in 2 hours is mine, but it does not sway my opinion.
And Delia, I wish we had a 1,000 people in the audience and we would all stand up and give you an applause for an excellent hour-and-a-half session. Thank you so, so much.
Thank you.
And we're going to say, Eugene, you want to come back on and say our goodbyes?
All right. Well, yeah, it's a good session. Thank you so much for all your time. Let me review the website just one more time for those that may not have seen it. And then after the goodbyes, we'll stick around for live Q&A. So for now, again, our website, iyme.org, will take you to itsyourmoneyandestate.org. If you click on workshops and you click on It's Your Money, and you go to the proper week, again, this is the final week of week 6 financial planning part 2. The video will be posted here and the related documents are found here. Just a reminder, we will be back in September, right, Pete?
Yes.
Great. Yeah. So in September, closer to that time, we'll release a schedule. But for now, this is the final session for spring 2024.
If you want
If
to
there's
do
any
the
other
open
questions, you
Q&A,
yeah, if there's any other questions, please ask in the Q&A section. But for the YouTube video, we'll say our goodbyes. And I want to thank Peter. I want to thank Dahlia. Thank you so much. Have a good day.